Hey gang, Dennis Tubbergen here with another economic update. Today is January 21, 2019. The chart that you see on the screen represents total global debt. And as you can see, total global debt has now reached a record almost $240 trillion. Global debt, as you can see from the chart, climbed 42% in the fourth quarter from just 10 years ago, and it's up about $100 trillion since the time of the financial crisis. Now, in a recent Forbes article, commentator John Malden, who is a money manager and best-selling author, he stated that a worldwide default on debt is coming. That may not seem like an overly profound statement, given there's $240 trillion in debt almost. However, Malden says, take a look at the U.S. government deficit. During the month of October, it was $100 billion. It was only $63 billion back in October of 2017. That's a 60% growth rate in just 1 year. Now, when you take a look at why this debt has built up, first of all, when it comes to public debt, Malden says that nobody's really complaining about it except for a few who are informed. So with no complaining, there's no pressure on Congress to take action. And the Federal Reserve has been aiding and abetting the government's deficit spending and monster debt accumulation by keeping interest rates low and buying U.S. Treasury bonds by the truckload. However, those factors are now changing. Malden reports that last year, interest on the federal debt was $263 billion. The Congressional Budget Office, or the CBO, expects that by 2028 it will rise to $915 billion. $263 billion last year, 2028, which is just 9 years from now, $915 billion, about 4 times what it is now. When you add the off-budget items, that number is $1.5 trillion. Malden adds that someone might not want to put a lot of stock in that number, since the CBO forecast the 2018 deficit to be $778 billion when it was actually $1.2 trillion. So the CBO does not have a terrific track record when it comes to making these projections. They've tended to be conservative, and the CBO also assumes there will be no recessions or wars in the next 10 years. Now, even with these optimistic assumptions, the Congressional Budget Office projects that interest on the debt will be greater than defense spending and all other discretionary expenses. That's just public debt. We've got private sector debt to deal with as well. Malden said that as far as government debt is concerned, there'll come a day that debt cannot be rolled over as it is now. And when private sector debt reaches an unpayable level, and I would argue that we're there now, we have 2 big problems. Malden uses the term co-morbidity to describe it. Co-morbidity is a term that's borrowed from the medical industry, and it's a term that physicians use to describe 2 life-threatening conditions that simultaneously jeopardize a patient. Well, as far as economic health is concerned, we've got public sector debt and private sector debt that we're going to have to deal with. Now, here's the rub. When the private sector is up to its neck in debt, it makes it a lot more difficult for the government to tap the private sector for cash to make up funding shortfalls. And since banks have private sector debt as assets, when private sector debt goes unpaid, banks lose assets and become insolvent. Malden says that because of these facts, we will have to see a great reset. I agree. Let me put this into perspective as I close. At the onset of the Great Depression, U.S. government debt hovered around 20% of gross domestic product. Private sector debt totaled about 240% of gross domestic product. 20% government debt, 240% private sector debt. Total debt was 260% of economic output. Today, government debt's over 100%, about 100% of gross domestic product. Private sector debt's about 203%. Add the 2 together, we've got about 308%. So debt today is significantly higher than it was when measured in terms of economic output than it was at the beginning of the Great Depression. So how do you survive, even prosper during a reset? Well, I talked about this past week with my guest on the radio program, Mr. John Rubino. You can check that out at retirementlifestyleadvocates.com. The podcast is now posted. But the bottom line is this. You have to look at investing and managing your assets in a non-traditional way. We call it using the two-bucket approach. Because one of two things will happen during a great reset. More likely, we will see deflation. Money will disappear from the financial system as debt goes unpaid, since debt and money are essentially the same thing in our system. And we will see stocks crash, we'll see bonds crash, we'll see real estate crash. The other option that policymakers will have is to try to print money to make up the debt shortfall. When that happens, like it has in Zimbabwe 10 years ago, like it is in Venezuela now, we get a hyperinflationary reset. You need to have assets that will perform well in a deflationary environment or an inflationary environment. I'd encourage you to check out the podcast at retirementlifestyleadvocates.com. That's my economic update for this week.